The broadcast is now starting. All attendees are in listen-only mode.
Good evening, everybody. Welcome to the exclusive Options Alerts webinar, revealing the keys to the options trading success. My name is Garreth Soloway. I'm joined by Nick. How you doing tonight, Nick?
I'm doing great, Gareth. Great to be with everybody tonight.
Absolutely. So, guys, it's great to have a great group here. I mean, this is fantastic to see how many people were able to come out and join us for this Options Alerts webinar. And again, tonight we're not going to cover all the nonsense that, you might have heard about options. We want to keep you guys crystal clear on what we do, how we do it in the Options Alerts, because again, there's a lot of nonsense out there. You'll hear tons of stuff on TV, doing a straddle, doing this, that. That, to be honest, is a lot of complexity. You want to really simplify it down and just make it into something that you can base off of and make money off of. And profits are the ultimate goal, right? So that's what we're here to do, and really great to be a part of it. And again, guys, you have any questions, you guys know the box is here to type in. We're more than happy to get to any questions you guys have. But ultimately, I want to get started into the Options Alerts webinar, and then we can ultimately answer questions throughout it and at the end of it, okay? Leanne saying, can we get a copy of the video? Yeah, I believe there is a copy of the video that will be made available. So, it's more for people that can't attend, but I'm sure if you email support, you'll be able to get a copy of the video as well. All right, Nick, anything else to add before we get into things?
No, I don't have much, Gareth. I think we could get started, and I think a lot of the presentation will clear up some of the members' questions. So I would just add that if they maybe the members want to just hold off on questions until we present our material, and then any questions you have from there, we'll happily answer them.
I think that's a great idea, great idea. All right, so bottom line, let's just ask this question out there. How many of you have never bought or sold an option before? Can you just type in, me if it's you, and just type it in. Give us a sense of, the kind of level of options traders and investors we have in the chat room or in this webinar tonight. So Don's saying he hasn't. Okay, excellent, excellent. All right, good, good. A couple others it looks like have as well, but for the most part, yep, there are a couple more coming in. Andrew, Jesse, great to see. And again, that's what we wanted. We wanted to get people that kind of didn't feel comfortable enough to get to the Options Alerts because they just have never done it before, so they didn't want to be kind of thrown into the Shark Tank. They wanted to get a sense of it beforehand. So I congratulate you guys on taking that first step and ultimately using this webinar to get your feet wet. And we hope you walk away more confident in terms of taking the options trades, especially with our guidance. All right, so we're going to start at the very beginning here. What is a call option? Okay, a call option is an option to buy assets at an agreed price on or before a particular date. So when we hear of date, we hear expiration, right? That's going to be the common term that you're going to hear. All right, so basically a call option, if you think about it, it's an option play, and a call is referring to what direction essentially you're going to want that stock, the underlying stock, to go. So in this case, a call, you want the underlying stock to rise. Think of it as going long a stock, but you're using a way more leveraged product to get a bigger bang for the buck. Now remember, there are caveats and there are cliffs that you can fall off of, and we're going to get into that as well, and that's why they are very, very risky. Okay? Next up, what is a put option? A put option is an option to buy assets at agreed prices on or before a particular date. With a put, think of it as a short. All right, put and short are somewhat synonymous, just like call and long are somewhat synonymous. So ultimately, if you buy a put on, let's say, Microsoft, you're betting that Microsoft is going to fall. You're using a leveraged product, therefore, ideally, the theory is you're going to get a bigger bang for your buck. Okay? What is a strike price? And we're going to go over all these terms with the options trades that you're going to need to know. The strike price or exercise price of an option is the fixed price at which the owner of the option can buy, in this case, in the case of a call, or sell, in the case of a put, the underlying security or commodity. So again, you could buy a put or a call on oil, on, again, Apple, whatever it may be. And again, calls are long, puts are going short, and when you have the exercise price or the strike price, that's the price that the stock must be above for calls or below for strikes, for puts. Okay, so let's just do a quick example. Nick, do you want to kind of tell them a little example about how to understand that maybe?
Sure. Basically, what you're looking at is, just say, for instance, we're going to trade any stock out there. We could trade, say today, Visa. Visa right now is trading at $65. So if you pull up the options chain, and that's what we call, that's where you're going to find all the different types of options that they have out there. What you're going to see here is that you want to be able, if you're going to buy a call, you want your call to trade above that strike price. Now, if you buy it a strike price, that's what we, and Gareth will get to this in the money and out of the money. We'll talk about that in a little bit. But basically, you're just looking to buy an option and have it trade into that strike price or above it, and your option should decently go in the money. And then we'll talk more about the criteria of picking options out in a little minute. And you can see here, as Gareth is putting the options chain up on the screen, how you can find out all the different strike prices that are out there. And then next to it will be the expiration. And that's basically what we look for when choosing an option. Later we'll get into different criteria for picking the stocks that we do to trade the option.
Okay, so just to kind of go over it in terms of this, guy, since a lot of you guys are totally new to this game, I use TradeStation to do my options trades, and easy enough. Let's start from the very beginning. So see this little kind of search
Little magnifying
thing.
glass.
Yeah, little magnifying glass. Let's say I just want to pick up, I don't know, let's look at the USO. I have USO closed today right around that 1750 level. So let's go find out what the options are on the USO. So type in USO, click on Look Up. All right, it's going to bring up, here's your expirations, which we'll get into in a minute. Here's your strike prices, and here's your types. You got calls, and then you got puts. And then, again, as you get further out in time, notice how the dates get further and further out. We can go all the way down to July and so forth. You're still going to see calls around that price of the current stock and puts. All right, and this is all for the USO. So again, let's just say 1750. Let's say the third Friday of the month is going to be the 17th. So let's say we want to buy a call at a 1750 strike, okay, on the USO that expires this month on the third Friday of the month. Okay, so that's right here. And that's that information. Now, in other words, for you to have this option close, this call close in the money, remember, a call is a long, so you need the stock to be above the strike by the time it expires. Okay, so for instance, if the USO towards the end of expiration, just before this date, 4/17/2015, is at $19, well, per the expiration, when it expires, it's $1.50 in the money. Now, you might have only paid 50 cents for that option, but you tripled your money just on a $1.50 move on the USO, and that's what we talk about, that leverage. Now, the caveats, which we're going to get into in a minute, are if it expires out of the money, you lose everything. Okay, and we'll get into that more and more, but I just kind of wanted to show you. So let's go back to the slides here. All right, so again, the strike price, we got that down. That's the price that you're buying that you either want a call to be above or the stock to be below the put strike price. All right. What is the expiration date on an option? The option expiration date is the date on which an options contract becomes invalid and the right to exercise no longer exists. Please note, you never really want to exercise the option. A lot of people, oh, well, what the heck, I'll just exercise the option. Well, in terms of how many shares you're going to have to buy on a decent-sized option trade to exercise it, it's not feasible. So really, your brokers, unless you specifically request it, if your option expires out of the money, meaning worthless, they're not going to give you the shares in your account. You would have to specifically ask for that, and they'd have to prove that you have enough money in your account. Now remember, it's like leverage. It's like getting 100-to-1 margin. I mean, the amount of shares that you're going to get it's again, not feasible to do. So really, your goal is to just, you want to play these options. You want to be out by the expiration, by the date it expires, either in the money or worthless out of the money.
Garrett, it may be important to just also let the members know that every contract is equal to 100 shares.
Right.
So 100 shares of stock. For every contract you buy, that is equal to 100 shares of stock. Okay, so in other words, just say you were going to buy 100 shares of Apple, basically you're going to have to put up that money, whereas you buy one contract of the option, it may only cost you $1 for a particular strike price. It's really a cheaper way of playing the stock market. You could do it with a much, much smaller account, and that's the benefit of it. The negative of it, obviously, we'll get into the negatives in a little bit, but is that you can lose, it is risky, and you are going against time.
Absolutely. And I think that's such a great point that Nick brings up. I mean, think about the money it would cost to buy 100 shares of Apple, and if you just buy one contract, that's basically what you're doing, but you can buy a contract of Apple for a couple dollars. You know, I mean, it's minimal money in terms of what you'd have to spend. And that's why a lot of, in all fairness, a lot of smaller traders are attracted to options because of the leverage essentially that you're getting on these options. All right. Next up, the in-the-money stocks methodology on options swing trading. So let's get into this, and this is really where, all right, we've covered the basics. We understand, strike price. We understand expiration. And again, I just want to show one more time here. Again, let's just search another contract just to make sure everyone's familiar with this. Let's look at, I don't know, Yahoo. Let's go to Yahoo, see what we got here. So here's Yahoo. I just brought up the options contracts on Yahoo. Your symbol over here, your type, which is either a call or a put, so it can only really be a call or a put. You either got to do one or the other. Your strike, which is what price. Remember, if you're buying a call at expiration, you need it to be above that price. If it's a put, you need it to be below that price. That's the strike. And the expiration is right here. You can see 0402. So these expire on Friday. Remember, there are weekly options, and those are the ones that are weeklies. And then the third Friday of every month is the big one. That's the one we talk about. That's where you'll get a quad witching, for instance, every so often. Okay, and you can just kind of zone. And so if you're really looking, like let's say you say, oh well, Garreth on the options alerts bought June calls, right? Okay, we'll just go down to June. Go look for the expiration. Go keep going. And down here you have June 19th, which is the third Friday of June. And here are all your strikes. So you want to kind of look at the strikes. What do you want? And now do you want calls or puts? And you make your decision based off of that. Okay? All right, let's go back to the slides here. Let's get into the methodology. Okay, the in-the-money stocks goal, guys. We strive to make consistent profits in the options market by only buying calls and puts. We don't use any option strategies such as straddles or spreads. We are simply looking to capture a gain in premiums paid. This keeps everything very simple and less confusing for those of you that are not very familiar with the options market. You'll hear a lot of crazy stuff about, oh, well, if you buy an out-of-the-money here and you buy this here and you do this and that, well, then you take a small premium as an easy money profit. Well, yeah, I mean, sure, you want to do all that. There might be maneuvers to do. But honestly, when I'm doing these, I'm using less money than I do on swing trades, and I want to make money. I'm not there to make $300 for the week. I'm there to double my money on a few options trades, and that's our goal here. So obviously there's some risk involved in that, but that's why we buy less amounts of money in our options plays, and we're going to get into that in a minute. What is the most you can lose on any options trade using this method? The most you can lose would be 100%. On a put or call, if you buy a put and it expires worthless, if you buy a call it expires worthless, you lose basically your whole investment in that. That might sound like a lot to you, but that's why you're only supposed to put a small amount of money in here, because on the other side of the coin, you can actually make 100. You can make 300. You can make 500% on certain options plays. Some methods, your loss can be unlimited. Believe it or not, I was with a broker probably about 4 or 5 years ago maybe. I have a couple accounts with different brokers. And this broker, they had a client that I think they must have sold calls. All right, now and this is something we don't do, but when you sell a call, you're basically selling it to someone out there, and if that stock gets bought out for, let's say, 100% premium, that option could be worth thousands of percents more than it was the day before. And I still remember a broker actually had to close their door. I think it was a biotech. It was either Great Drug News or something, and they literally went out of business because the client couldn't pay for the loss that they had incurred. It was hundreds of times his account value, and obviously who's on the hook? The broker, and that's why the brokers don't really like you doing these type of things. And honestly, we don't like it either. All right, there's no reason you should ever, it doesn't matter what investment, the worst case you should be, you should run out of money on that investment. It should be a zero out. It should never be much more. It should never be anything more than that. All right, in terms of what we recommend, 1 to 3% of your account on our options portfolios, okay, on a specific trade. So if, I put out a trade on Apple or Nick puts out a trade on anything else, what we're recommending is just take 1 to 3% of your portfolio and put that in. You could choose 1, you could choose 3, you could choose 2.5, whatever you want, but don't do more than that because, again, sure, Nick and I are great at calling out stock trades, right? I mean, we're great at this, but in all fairness, we are going to take some losses. In fact, I'm sure every month I'll have maybe one or so options contract expire worthless. You don't want to put 50% of your account in that one, and then that's the one that is going to expire worthless. Okay, so that's really important. And remember, when you're making, I think right now for the year we've netted 1,300% or something. When you're making crazy returns like that, you don't need to bet a lot on them. You just want to just think about try to double your account on options every year. Now maybe you'll double it 3 times in a year, but the point is start small and work at it. Don't try to hit a home run. We always say we strike out when we try to hit a home run. I can't stress that enough, right, Nick? I mean, it's crazy.
100%. And Gaz, if I could just add one thing, interject here. Mark had a good point. Before we talked about how you could buy a contract for $1 or so, but that, as Mark is saying, if you buy that contract for $1, it's essentially costing you $100 because you have to buy, it's 100 shares. So every contract equates to 100 shares. So if you buy a contract for $1, that would be $100. If you buy a contract for $2, that would be $200. So I just wanted to clear that up for everybody out there.
Yeah, it's a great point. That's absolutely a great point. Let me just see. There was one more thing I was going to mention here about risk. Oh, yeah. So and I don't know if Nick does this, but what I do is I have a separate account for my options trades, and I have a swing trading account with a lot of money in it, and then I have a separate account that has a lot less money in it, and that's what I do my options in. So, again, I'm not tempted to, dip into any extra. I really keep myself kind of boxed in and say, here's my options trading account. It's valued at this. Now 1 to 3% of this smaller amount of money, that's what we're going to be using. So you really want, again, I can't stress it enough how, you can go through a bad area or bad cycle in options and really, if you put a lot of money in, you can get hurt a lot. And we don't want you guys to be in that position, all right? This is something where if you lose a few times, okay, so what? I lost 5% of my account, or I lost 7%. All right, well, I just now made 100% winners in options. Now I'm way above what I was before. You shouldn't allow any 3 losers or 3 expirations of worthless options to ever cause your account to take a major hit. It just shouldn't do that. If you do that, then honestly you're risking way, way too much.
Absolutely. I agree 100%. And the same goes for any account that you have. Even if you're a swing trader and you're just trading, you don't want to over leverage yourself ever to one position, and that's just a golden rule to keep yourself safe and also allow yourself to have money to enter other positions when they come along.
Right, absolutely. I think that's so important. You never know when the next opportunity is going to pop up, and you don't want to be sitting there saying, darn, I wish I had some money I could use, right? All right, guys, why do you risk less on options trades than other stock trades? You risk much less money because you're dealing with a new X factor, new dimension. You now have to factor in time value. Okay, so again, we all know swing trading using the PP10 methodology is awesome, right? But it's still kind of hard. I mean, you got to still look at the charts. You got to know PPT, price pattern, and time. Now, imagine this. Imagine as an options trader, not only do you need to know PPT, price pattern, time, but we're going to throw a new dimension at you, which is time. And again, time value is that expiration date. Okay, so as if reading charts weren't hard enough, now add that in. And what does that mean? Well, basically, let's say I have an expiration on, and I do have a few expiration plays in the options alerts that expire on the 17th, which is the 3rd Friday of this month. All right, every day that goes by, and there's not that many days before that expiration because there's only 5 days in a week, and Fridays the markets are closed anyways. That option, especially if it's out of the money, is going to be worth less and less because time is becoming less and less as we get towards expiration. So it's going to expire worthless if it's out of the money. Every day that passes, there's less time by a percentage. You could figure that out. If there's 15 days left, and that means every day would be 1/15 of the price. Well, that first day would be 1/15, then it would be 1/14 vanishing, and 13, etc., all the way down. So you're dealing with this new dimension that's going to really cause an erosion of the value of that option. So that's probably the biggest key here to understand is that as time passes, your option will automatically, even if the stock stays at the exact same price, let's say the USO's at 1750, every day that passes where it stays at 1750, you're losing some small amount of value until ultimately expiration. And if it expires at that strike, then it's worthless. Okay?
So a good way to remember it is there's always time decay, and it's not on your side.
Right, right. Just like if you think about it, the same thing in our lives, right? I mean, every day we get older, it's one day closer to that unfortunate demise.
That's a good way to look at it.
All right, so on the bright side, while riskier than stocks, the leverage on an option allows you to make north of 100%. We talked about this. And literally, I've seen, for the most part, if a stock moves 5 to 10%, you're probably making about 100%, give or take a little bit on that stock. So it doesn't take a big move to get these options to make a big move. And that's, again, because you're leveraging it so much. Think about it like kind of like a 10 to 1 leverage almost, where a 10% move in the stock makes 100% on your option. Okay? All right, let's go on to the next slide here, guys. And again, at the end of these slides, we're going to take all these questions. Anyone who has questions, again, just be ready, and we'll take them all then. All right, analyzing premium. Before buying any call or put option, analyze the premium and what you need the stock to hit, worst case, to break even. So, again, this is very important, guys, and we're going to go into this more here. The premium is based on time, but you can also see an additional premium put in on plays or on stock options when you have more volatility expected. I think, Nick, you ran into a great scenario here. I remember you telling me about it, how you bought at one time options, I think it was on Apple or something like that, and even though the stock went in your direction,
it was
there
Google.
Was so much
Google.
Yeah, less volatility after earnings, that they just didn't do much, right?
Right. I bought a way out of the money option. This is one of the reasons why you don't want to stray too far out of the money. The stock actually was right near the money, and being near the money or in the money, once a stock is above your strike price, just say you have a call option that's above your strike price, you're then in the money. So just so everybody's clear what that means. But yeah, that did happen. Stock after earnings got to my level, but guess what? It just didn't move. It didn't move the needle at all, and I had to, have that option expire worthless. So again, you want to trade things that are going to be effective. I know a lot of you hear the term open interest. You want to have good open interest, but more importantly, you want to have stocks that are really going to be movers and shakers, and those are going to be the ones where the institutions get involved, and you're not going to have to worry about that happening too much. But again, as Garrett alluded to, we try to stick with things that are not too far out of the money. The only time I'll really go out of the money now is if I have a real good mathematical level like I did with Wynn Resorts, and I was very confident that stock was going to go down to 122. And I know a lot of you that were members a couple weeks ago that were in that trade with me were like, this guy's crazy, it's never going to get there, and it ended up working out. So that's a couple times I will go and buy an out-of-the-money option because I have a lot of confidence that it's going to pay us in a big way, and that one absolutely did.
Yeah, absolutely. So again, guys, with premium, there's going to be an added premium that you're paying for when there's expected volatility in the stock. So again, if you're coming into earnings, you're going to pay more. Like, we never recommend doing options before earnings because you pay such a huge premium that the stock has to move ridiculously on earnings to make you any sort of money. And if it doesn't, if it just stays flat, if it just goes a little in your direction, or if it goes the opposite way against you, you're going to end up taking a loss, even again if that stock is somewhat moving in the right direction. Same thing can be said for like a lumber liquidators, right? So interestingly enough, if we go to lumber liquidators here, let me move this out of the way, but let's just go to the chart on lumber liquidators, right? So when that lumber liquidators was falling like this, I looked at the options, and I did play some options at one point, but I looked at the options and I had to really analyze, would the premium that I'd have to pay for options on this be worth it? Okay, and I had to say to myself, well, what type of balance do I need to get to make this worth my while, where I'm going to actually make some money, and is that too risky? And again, the whole idea was lumber liquidators was crashing, so everyone was assuming at some point it was going to have a big bounce, so anyone selling those options to people like me, they were charging a huge premium, huge premium. Now again, in certain situations, if you nail it dead on, yeah, you'll still make money. But if you're off, you're in a lot of trouble. And again, that's really a big issue there. So always remember that. I want you guys to look at the premium you're paying for that option, then calculate in your head how much the stock must move or the option must move to be at least break even. For example, XYZ trading at $30 a share. Garrett is interested in buying calls. 2 months out, expiration, so that would be 2 months from now would be the expiration on the calls. The $30 strikes are trading at $2. So the stock is trading right at the strike that I wanted to buy, and I'm going to pay $2. So what that means is the stock, and the question here, what does the stock need to hit to break even at expiration? Okay, and the answer is it has to be at 32 because I paid $2, so it needs to be $2 in the money. Now, imagine if I was buying a stock at $30. Let's buy calls again. Let's assume it's calls on XYZ. $30 strike calls, expiration 2 months out. But I was paying $10 for them. The premium was $10. That means the stock would have to close on expiration around $40 for me to just break even. Now, ask yourself in your head, what are the odds of that happening? Well, you know, maybe it's a small one, but I mean, for the risk that I'm taking, probably not too good. Okay, so things like that you want to pay attention to. You really want to kind of look at that premium, and what you're going to notice is, well, some of the favorite things I've done is I love stocks, and I think this is on the next slide. All right, so how do we choose the options plays? Falling knives and major pops into resistance. As long as they're not too dramatic, you're going to get a low premium basis. So, for instance, like an SDRL, I've seen Chesapeake. So those have kind of just been slow draggers and continue falls for like 6 months, a year now, and they've just gone straight down with small bounces along the way. Sentiment is very, very negative on those sectors, right? So the premium is going to be smaller because everyone's so negative. Okay, when everyone's expecting a bounce, that's when premium is going to jump up. All right, remember, kind of think going against the grain, and then again, always analyze that premium. So again, falling knives or major pops are great ways. So into support, into resistance are great ways to do it, and then also PPT. I mean, I'd say a majority of plays that we choose to do options on are based purely off PPT. It's either a pattern with a time count or other methods like that. And it's, again, it's just looking at that. You want to kind of think about expiration, which we're going to go into a little bit more, and obviously strike generally around the strike price around where the stock is trading at the current levels. Okay, best falling plays are ones that sentiment's extremely bearish on, keeps premiums low. Same thing on the opposite side. If you're looking to buy puts, which you want the stock to fall, and it's been a stock that's just been continuing to slowly grind up for a year, well, the premium on those, because no one expects it to fall, is going to be a little bit lower. There might be an opportunity if you can match the chart up with PPT, right? So it all comes down to that classic PPT, price, pattern, and time. And again, guys, if you haven't taken Nick's methodology revealed course, can't stress that enough. This is where it's at. This is how you're going to continue to be successful, whether you're trading options, stocks, commodities, doesn't matter. Okay?
In fact, Garrett, every trade pretty much that I have taken via the options has all been done with using the methodology. So PPT has been involved in every single trade that I've taken this year. So we've had a couple, I mean, 2014, I think 2015, I only have had one loss, but either way, PPT, I can't, as Garrett said, is critical. I mean, if you guys are not learning it, or you don't know it, or you're not practicing it right now, you're doing yourself a disservice. It's a life changer. So, I mean, it's changed our lives, and it's changed, you know, hundreds, if not thousands, of members' lives. I would recommend that it's a must-do at some point in time, and you pass it down to your children. That's really what you do with it.
100%, 100%. Jerome, I just see this is related to premium, so I just want to cover it real quick. He's saying, what's the rule of thumb for premiums? Is it 10%? So basically that you're paying a 10% premium to buy that option, so you'd need the stock to move 10% to kind of break even. The way I look at it is this, is you really need to analyze the beta, the volatility of that. So for instance, Disney, right? Disney's a very slow mover. If I bring up Disney options, whether they're calls or puts, my guess is you shouldn't need it to make, it should be less than 10%, okay? Now, if it's a super volatile stock like, you know, Lumber Liquidators lately or some of these other ones, it might be more. But again, you have to kind of look at the volatility of the name. You could even compare it to that volatility of the stock itself. And again, most of them have, I think, betas listed on like Yahoo Finance and stuff. Okay.
Yeah, just as a general rule, as long as you guys use trade liquid names, and for the most part we do that, you should be fine. Stocks that aren't so liquid or don't have a lot of natural volume in their trading activity, those are the ones that those are the equities that you could come into a little bit of trouble with. But I mean, for me, Gareth, my experience is, you know, I like to trade household names anyway, and that works really well with all options.
Absolutely, yeah. I mean, when you're getting into stocks like Exxon and Chevron, Disney, and all those names, IBM, they're going to be the options will be pretty solid. I mean, you'd have to see something pretty crazy not to think that, as long as you have the right chart set up based on PPT, that you wouldn't be paying the proper premium for them, okay? How do we choose the strike price? All right, so generally I choose, at the money, which means, again, right at the current stock price. So, again, for instance, on the USO, 17.5 would be a proper strike. Occasionally I'll do 18, 18.5, or maybe sometimes I'll do in the money slightly, but I kind of stay right around there. The main view, and again, sometimes you can take the long shots of buying out if you have a really good indicator like Nick was talking about with Win, but I view it like even if the stock is slightly out of the money coming into expiration, at least on that last day or last couple days before it expires worthless, maybe it pops up and you can at least break even or cut your loss a little bit. And if you're really far out, I mean, if you buy a strike of 20, right, and the stock is at $10 and you're just banking on a home run, like a drug trial coming out, I mean, really going into that last day or so, I mean, if you're still around $10, you have no shot. I mean, it's virtually, unless they get that news on that particular day, you're going to expire worthless. So I always like it kind of right around there, okay? Let's go on to the next one here. So how do we choose the option expiration date? All right, always give more time than you need. I think Nick and I would agree, and I think it's the humble side. How many times have I put out a trade and it just doesn't happen right away like I thought it? It took a little bit extra time, maybe an extra week, maybe an extra couple weeks, maybe a couple extra days to play out, right, when you have a setup. And, the biggest fallacy or the biggest fault for us, you never want to think you're going to be dead on right away. Because as soon as you do that, then that makes you say, oh, well, what the heck, I'll buy Friday's expiration because this is going to move tomorrow. Well, guess what? If it doesn't, you just lost all your money, right?
That's right. Absolutely.
So you want to just assume you're going to be a little off, and at least that buys you some time. I think both Nick and I would agree you want to buy at least 1 month plus out. So, for instance, if I was going to buy options right now, the earliest month I'd buy, since we're less than 1 month from the April expiration of April 17th, I'd be buying earliest May's right now. And sometimes I might even buy June or July's, to give myself a little extra time. Okay, I think right now the market's a little kind of wacky. So I like to give myself even a little extra time on most options plays because I just don't know in the short term how things are going to play out, even if I have a good read on a little bit of the longer term. Okay. Bear bull flags with time counts get a little less time. I still do that 1 month plus, but maybe you don't do 2 month plus. You do 1 month plus if you have a really good setup, especially with a time count, because that time count is going to give you a very specific trigger point to make a move. So really, if it moves right there, you can rock and roll with it. You make good money. If it doesn't, you can even just stop yourself out for a small loss, as long as you give yourself a little time.
And again, that's another reason to really learn the methodology. So I mean, that's a perfect example right there. There are a lot of trades where I've had moves happen in one single trading day, where the stock has jumped 50%, 80% in one in an afternoon that quickly, and that's all off of knowing the methodology.
And then just the last one here, guys, charts at dead lows and dead highs or absolute highs. You want to give a little bit more time because they're momentum plays. A good example of this was with oil. Oil's obviously been at long-term, multi-year lows at this point. And I think it was just a week or so ago we got a pop. I was literally out of the money, down 90% on my USO calls, and then we got a pop. And I knew we were into some resistance, and I was going to take a little bit of a loss, but I gave myself enough time where that pop could come in, and I think I just took a 16% loss on those options after being down 90% on them. And that was fine by me. I mean, you have to understand at certain times to just say, okay, enough's enough, and move out. But the key is, again, giving yourself more time, especially on charts that are at highs and lows, because they're momentum plays at this point. I mean, you don't know if an institution's just continuing to sell, and if you're saying, well, I think this is going to bounce by Friday, I mean, if you're just off by a little bit, you, again, are putting yourself at undue risk. And just give yourself a little bit more time. Sure, no one wants to pay more of a premium for time, but I can't stress enough, it's worth it. I mean, people, again, so many small investors are like, oh, yeah, but I have to pay $1.20 instead of 30 cents for 2 months out. It's worth it. Trust me on that.
It pays for itself. It's like insurance, Yep. Not that long ago, Gareth, one of the losers that we've had in 2015 was my GE trade. And just a week later, if I would have had a week longer, that trade would have worked out, and I would have I would have probably banked about 30-40%. Instead, I lost 48%. So I can't stress it enough that to buy that extra time, it's insurance, and it's worth every penny.
Absolutely. All right. How do we know when to take profits? All right. Well, the first things first, right? We always want to look at the chart. The chart is the best indicator. I mean, if you have a 3-bar surge off of your entry, you might want to, and this just got a little bit of a blip on the screen, but point is here, guys, just going back to what I was saying, is if you have a chart, right, that's about to make a move, all right, and you make a 3-bar surge to the upside, you want to be very sure that that option, right, so let's just say you're up 100%. Now, you might think in 2 weeks that's going to go higher, but remember, time value is constantly expiring. So just be sure about that, folks, is that it's not a bad thing. If you get a 3-bar surge and you even are up 50%, sure, you could go and make another 150 maybe, but I always recommend being smart about taking profits with options because they are so risky in that respect. And literally a 3-bar surge and you get a 1-day pullback, you'll lose 30-40% of those options right there on that pullback day. Okay, I don't know if you've had any experience with that, Nick, but I mean, it's been pretty nuts how that works.
Oh, absolutely, and that just goes back more to the methodology. I mean, so if you have the opportunity sometimes and you see a pattern change and you have profits on the table via the option, I mean, it's sometimes a good time to lock them in and protect yourself. And you could always, trade again. I mean, that's the beauty of this business, especially if you're around the computer like we are every day. But I agree 100% with you.
So again, lastly, just to point out this too, and I kind of mentioned this before, but if you're down a lot on the option trade and it pops, and then you're close to expiration, you really need, like, again, the same thing with the USO. It was expiring coming up. I had to make that decision. I only had a couple weeks left, and I knew any sort of small pullback in the USO meant I would expire worthless, and I would lose 100%. So when I was only down 16 after being down 90%, you have to be ready to say thank you very much. That's a win right there. I look at that as a win because then I can go look for another option trade, make 100% here, 100% there, 100% there, and as long as you're losing and trying to lose small, take those opportunities and enjoy them. Trust me on that one. Okay?
Absolutely. In fact, Gareth, GE was a perfect example of that myself. We had a nice move higher, but we just had no more time, and I had to close out those options and took a 48% loss, but it could have been a 100% loss. So just trying to use the best money management that you can at that stage of the game.
Yeah, that money management is unbelievably important, folks. I mean, if you think about it again, when you're down 90%, I mean, again, when you're dealing with small amounts of money and options too, if it's just a few thousand or 5,000 in an option, if you're down to 500 value of all your options, and then all of a sudden it goes from 500 in a couple of days, sure, maybe not back to 5,000, but maybe it's back to 3,500. I mean, think about the move and just imagine. You can't think in absolutes in terms of, well, I had 5,000, so I don't want to take a loss. You have to say, this was worth $500 yesterday. It's now worth 3,500 today. That's a big move. Take that money and run. I mean, that is unbelievably important. Yep. All right. So how do we know when to take a stop out or a loss? I personally, Nick and I, a little bit different here. Like Nick will use some stops on options. I basically go into them with the idea that it potentially could expire worthless because options can be very whippy. And Nick trades a little bit more liquid ones, which makes it a little easier, and I know that. But sometimes I trade ones that aren't quite as liquid. So you have to just say to yourself, for me at least, I understand I could lose all my investment here. That's the basis. Now, ultimately, I believe based on my PPT analysis that I'm going to make money. But I think, Nick, on your side, you're using more liquid options, which enables you to kind of keep some stops on them often.
Yeah, I really do trade just more household names with them, just because we do have so many institutions in there, and it's never an issue really to get out, and I could chart it better. Everything that we do, Gareth, has to do with the chart. So that's the reason, and it just becomes a little bit more challenging when you use less an equity that's a little bit lighter volume traded equity. So that's why I'm able to do it. And a lot of times I'll go for the gold with the second target, and I'll move my stop to break even, and I'll get some stop outs there as well. But the liquidity for me is the key, and I kind of want to stick with those liquid names. I feel it works best as long as I can match up the chart perfectly.
Question here from Trevor, what's liquid? So basically when you're dealing with options, you just want to see something that has volume and a decent amount of volume. And weirdly enough, option volume isn't necessarily going to be that high. You're not going to see, tens of thousands of contracts traded or even hundreds or millions of contracts traded. I don't know, Nick, if you have a general rule for liquidity, but I would say, north of 1,000 contracts a day would be considered very liquid, I would think.
Yeah, and more so than even the liquidity in the option, I'm really more concerned about the liquidity in the stock itself. So just say you're looking at, just Apple, for instance, and Apple, trades 40 million shares a day. I'm not worried about that at all because I know once that stock moves in my direction, the premium will move up in the option. So when I talk about liquidity, I'm really focusing on the liquidity of the equity more so than anything. The stock is going to, as long as it's a liquid name, meaning there's general good volume in the stock itself, there shouldn't be any problem. Once that stock moves, that equity, that option is going to move with it.
Yeah, absolutely. And David's saying here, let me see here. David's saying, I've put a market order to sell options but never got filled. Is this due to the low liquidity? To be honest, if you put a market order in, that you should have gotten filled. I mean, I would never recommend using market orders with options. Always use a limit order. But that is kind of weird, David, if that happens to you. The one thing, and I see this all the time, so like I'll buy an options trade and then I'll see, once I buy it, obviously I tell you guys immediately I bought that options play, right? And what I'll see is some people just going in and just paying the offer on those options. Do not do that, folks, all right? Use a limit order. I don't mind if you pay a penny higher than me or a penny or two higher, but do not hit the offer because you'll get filled at a better price by, using a limit order there. All right, and again, sometimes I'll buy some options that have like a 10 or 15 cent spread, and I'll see that from a few people in the options alerts, and I'm assuming it's people in the options alerts, and I just say, oh no, don't do that. I mean, you're just shooting yourself in the foot somewhat because you're just, again, a 15-cent move on a dollar option is 15%. That's 15% already you're giving up right there by paying up. So again, always use limit orders, guys, on options because again, the sharks are out there. They will get you, and you're only going to hurt yourself if you don't. Okay? We'll get to a couple more questions in a second. I just want to finish this up. How do we know when to stop out and take a loss? We kind of covered this. And then the question here is, do we ever buy the same option but on different months with a different strike or at the same time? Generally, I don't buy. Sometimes you'll see people buy Microsoft that expires in April, and then they'll buy right away Microsoft that expires in May and so forth out. I really don't do that. I'm looking at it like I don't want to be wrong double if I'm wrong, right? So if I'm wrong on the play, sure, I get a little bit more time on those, but if I'm wrong, I'm wrong. You're going off a chart pattern here. So giving yourself extra time on those maybe buys you a little bit, but by buying more options out, you're going to be giving yourself a little bit more of a risk side to it. You're basically investing more money, and if you're wrong on April's, you're going to be already fighting uphill on the Mays because you're going to be down 70%, 80% on those going into May. Okay? Now, having said that, a good example of what I do occasionally is what I'm going to talk about right now. So I talked to you guys about the USO call that I was down huge on it, and then I cut the loss when it was only minus 16%. I was happy with myself. I said, whew, thank goodness. That's a very tiny loss. Now, what I did do is as soon as we got a pullback on oil and the setup came to a key level, I then went in and bought a further out USO call. And that's what I have in the portfolio. I think I picked that up just a few days ago for you guys, and I believe it's in the money right now just a little bit based on today's move up. So I will do something like that, and I think that's okay to do. But again, if you get the big move up, I don't want to just sell that one for a loss and then roll it into another one when the stock has already popped or in this case, the ETF had already popped up drastically. Be smart. Go right back to PPT. Okay, well, now let me see. It just pops nice. I cut my loss for a small one now. Now let me see that bullish pattern of consolidation. Let me see a pullback to gap fill. Let me see, some other PPT factor, and then when I get that, I'll enter it at that point. Okay, so I think that's a little good side note to talk about. Okay, and on that note, folks, let's start taking some questions, and feel free to shoot us any question. But again, remember, we'll keep it on puts and calls. We don't want to get into straddles and that stuff. That's not what we're doing here tonight. That's not what Nick and I do. But again, feel free to ask us some questions now. All right. I'm seeing Ricardo saying, can I trade options alerts as swing trades, 10% of my portfolio if I don't want to pay a premium, or is it better to play as an option always? I mean, technically you could, but again, I think the whole idea of doing options is, and Nick, you could correct me, but I think it's more that you want to risk less money to make a large percentage gain. So, I mean, sure, I think, again, we're basing it off PPT, so you could do that, but I don't know if there's a real need to. Nick, I don't know your feelings on that.
Yeah. I read the question here. I wouldn't do that. I would stick with an options play simply because we're trying to capitalize and make big profits, risking a small amount of money. That's really why we trade options, and we've done it pretty successfully now since we started the program. If you go ahead and trade certain stocks, you could be in those positions for a while, and what if we're wrong? Then you're out of the money. So I would stick, because there's certain stocks I'm only going to do for options. And there'll be certain stocks that I would do via a swing trade, which I think is a little bit different. I mean, I guess as Garrett said, you might be able to do it, but for me personally, I would keep it the way we have it set up right now, because when we take these options plays, we're actually looking for big gains, and we're not looking for the stock to make some kind of grand slam move. We're just looking for that little move, but we've calculated out pretty much. All right, this could make me 50%. This could make me 75%, or maybe even a 200% gain. But that's you're not going to get that same play as a swing trade.
And I think that's the biggest point of it all. What Nick just said is that we may be in and out of an option where we make 50% on it or thereabouts, but the stock itself might have moved 2% or 1%. And if you're putting a lot of, I mean, you'd have to put a lot of the money in to be okay with just taking, I just made 1% on this stock and I'm done with it, And again, remember, sometimes they go against us where we lose 100% or 50% on those. In which case you're kind of stuck in it. And I think the key is probably just going with those options. If you're into trading for that type of smaller risk with a bigger reward, then you want to stick with those options. Absolutely. Okay. Leanne saying, can you tell how liquid an option is by looking at the difference between the bid and the ask? I would agree, Nick. I don't know how you feel, but I think usually more liquid options have tighter spreads, right?
Absolutely. You could definitely, if you have sometimes a 50 to 75 cent spread between the bid and the ask, it's definitely an illiquid name, and there you're kind of like guessworking, where could I get filled? And I really don't like those options anymore. We had that issue, Garrett. I think when we started the program up, we were trying to get into so many trades, and I'm like, oh, look at this. It's been a while here, but this bid is so far away from the ask. I'm not getting filled, and we would be sitting out there for a little while. So yeah, the tighter the better. That's the way you got to look at it.
Absolutely. And occasionally I'll put out some, especially if I'm going out multiple months, like I have some July and maybe even an August expiration, and those will tend to be thinner because they're further away. So as time gets closer, they're going to trade a little bit more with liquidity to them. But use me as your proxy for entry. So, for instance, if the spread's 20 cents, let's say, or 25 cents, but I got filled, let's say it's $1 by $1.20, but I got filled at $1.05, put yours at $1.05. Don't put yours. Again, don't hit the offer. Don't put it in the middle. Use me as your proxy, or even try to do better than me. I have no problem with you guys trying to get better fills than me. That's even better. But again, use me as your kind of barometer for where you potentially should put it if it is a little bit more illiquid at the time. Okay? All right, let's see what else we have here. Jerome saying, do you analyze the bid-ask spread? So going back to spreads again. Nick, do you do that at all? I mean...
Not really. I don't really analyze it. I just basically, as long as I feel that stock is going to move in the direction I think it is within that amount of time, I'm comfortable with that. So I'm not really, there's a lot going on in the course of the day when we're looking at all these different equities. So really, my analyzing is stock going to make a move? Is this stock liquid? Those are the two questions I ask myself each and every day on every trade. And if it is, I'm taking it.
Absolutely, absolutely. Mike asking, so one of your latest trades was a little bit on a shorter time frame. Apple buy call at 125 with an expiration of 417. Okay, so you want us to explain, or Nick, you have anything on that one?
I'll take that one because that's the one I put out. Yeah, if you look at the stock, I mean, I'm just basing it off of a calculation that I've worked out already that if it does fall, it's only going to go to around 118.90, and I think that's going to be where Apple turns up. Also, I'm basing it off of the weekly chart and my theory that the month of April should be bullish. So I have a couple of reasons for taking that play where I did, and I know it is a little bit out of the money now. It's sitting at around 81 cents, but if you've traded it with me, you know when Apple makes a move, that will make a move as well, and you know we still have a lot of time. We just entered the month of April right now, so I'm very comfortable with that still.
Nice. Don saying, for alerts, if you get out, should we close the option as soon as possible if I'm not seeing it in real time? So you're saying if you see the alert later on in the day, would you still recommend closing it? Yeah, I would say, I mean, that's why we're putting out the alerts so you guys can follow our trades. There's probably some reason why we're exiting it, whether we're factoring in a time factor or the chart or chart hitting resistance of sorts. So I definitely would recommend it, and I understand you guys are living lives, so you're not going to necessarily be right on point, as soon as we send out alerts. But in general, you just want to do your best to mimic what Nick and I do, and once you learn the methodology, and I think that Nick would agree, is that once you guys learn this stuff, then you guys go off and do it on your own, and we're happy to see that happen. But in the short term, yeah, you want to just kind of mimic what we're doing.
Yeah, and for the most part, what I see from the comments I get, especially from the chat room members, most members get better fills than us. They seem to get these options at better prices than when we enter them. So
that is true. I
think in due time they'll all be okay with it. I mean, it just every time I get in, it seems like I'm out of the money right away. So I've just grown to be used to it.
Yeah, and I think one thing I just want to touch on too, which is something Nick and I do talk about, is one of the main reasons we don't like holding into expiration. Some people will talk about doing that is that the institutions are definitely against you if you're buying calls and puts, and they're going to push that stock. Remember, they're the ones. Everyone can sell a put or a call and make a little bit of the premium, but really the institutions, big money, is the majority of that. So they have an incentive to capture as much premium as possible on all their options plays that they're selling to the public, and they're going to utilize, let's say they took in $100 million in, or let's say even smaller amount, let's just say $10 million on Apple premiums, okay? Well, why wouldn't they use $7 million to push Apple down into that expiration to make sure that they maximize their profit? I mean, of course they would. I mean, they're still net $3 million, right?
It happens every month. Every month during the week of options expiration, the monthly expiration, not the weeklies. It happens all the time. That's why we call it Shark Week, because these guys have sophisticated computer systems that know where the small retail options trader has placed his bet. They know when a guy puts out 10 contracts, 1 contract, 3 contracts. I sat at a wirehouse firm, and I'm not going to mention the name. A buddy of mine still runs the options desk there, and I went and I watched exactly how it's played, and these guys know everything that comes across. They know where the small retail options trader is versus the institutional trader, and the institutional trader has unlimited capital, highly leveraged capital. Just think about the average hedge fund. They're 20, 50 to 1 leveraged. They can move a stock if they need to for 3 to 4 days, and they do it each and every month right into options expiration.
Absolutely. Mike saying, is there a mental percentage gain you take when you take money off the table, like 30%, 50%, or 300? I don't have one set, and again, I'll let Nick speak for himself, but I don't have one set rule for that. The only thing I kind of follow is how long I've been in the trade. So, for instance, if I buy an options play and it happens to move 50% in a day, chances are I look at it like that's a day salary, right? So if someone said to you, I'm going to pay you $5,000 for the day, if you take it, will you take it? Well, yeah, heck yeah. Now, if they said I'll pay you $5,000 for a year of work, you'd probably say no. So to me, it has a lot to do with how fast it's given. I look at it like a salary, and again, you'll see sometimes I'll buy them, and the next day we'll be in the money 30 or 40 or 50%, and I'll just say, you know what? That's money in my pocket right now. Risk is off the table. I don't have to worry about what the VXX or what any of these other things are going to do over the next couple days. I just want to pocket that. Now, other situations where I'm kind of just sitting in them and the pattern is slowly moving up, I'll let them play out because I'm in them longer, and I'll try to take that full 100%. But usually for me, once I get around 100%, that'll be the max that I'm looking for. I don't want to get too greedy on them.
Yeah, as for me, it's more about the chart. So if like just say for Apple, I mean, we were probably up on that option. I don't know. We got in at $1.25. We were up about around the 140 area. I'm looking for more. So as long as that chart is telling me it still has upside potential, and I'm not talking about the options chart. I'm talking about the stock chart. I want to stick in it. I want to stay in there, sit in the pocket, and let it play out. And you know, we've done pretty well with that strategy.
Definitely, definitely. Jerome saying, speaking of bid-ask spreads, where do you draw the line and not play it? I always look for under 5-cent spreads. Your thoughts? I think that's a great rule of thumb, Jerome. You know, under 5 cents for a spread. I do sometimes, as you guys know, play spreads that are larger. A lot of times when it's further out, I'm buying a lot of time that way. But what I always do is I refer to what we did in the webinar just earlier tonight, which is I go into the analysis mode of analyzing what type of premium I'm paying for it. So again, for instance, SDRL July calls, $10 strikes, they're trading per close today at $1 by $1.25. You know, if I was going to pick them up, let's say, tomorrow morning with that spread, I'd be looking at, okay, well, how much of a move do I need? What do I expect from oil? I mean, I'd have to analyze all these various things, and then I wouldn't be buying them at $1.25. I would be buying them as close to $1 as possible, probably like $1.05. You know, so you really want to take in multiple factors, but I think for the newer options trader, definitely stick with the more liquid ones for the time being until you really get your feet wet. Otherwise, make sure you're just following us. All right. Let's see what else we have here. Yeah, Jerome mentioning Apple, USO have smaller spreads. Absolutely. Those have like, I mean, penny spreads, couple penny spreads on those. Mark saying, can you demonstrate an options play now with the stock of your pick, showing what you look at, including the percentage gain you'll look for, and the break-even point, how you implement the break-even stop? Sure, absolutely. All right, so let's see here. What should we take a look? Throw out a name for me, Mark. What do you want to look at? Give me a stock that's pretty liquid, though. And again, remember, a lot's going to have to do with the chart. A lot's going to have to do with the chart. All right, so Tesla, you got it. All right, let's bring up this. Let's go to our options. So before we do that, let's quickly bring up the chart of Tesla. All right, so, I mean, Tesla, I don't know how you view it, Nick. I see a little support right in this area. It's almost kind of sitting on top, maybe a little bit more downside, and then if it gets through there, it could go lower. But let's just say that we wanted to buy the 178s when it gets to 178, right? So we want to buy this little pivot area right in here. All right, so what we're going to do is, you know, let's look up 178 strike. So that's your strike. Whatever price you're looking to kind of around, you want to start right in that area. So Tesla, we type in TSLA. I press look up. Okay, now let's say we want to buy a month and a half out, so we're going to buy the Mays. Let's go down to May. May 15th is the third Friday. And now we start looking, so we're looking for longs because we expect to bounce off support in theory, right? And here's your calls. So that's if you're looking for a up move in the stock, you're going to look at calls. All right, here's your 175. So I have a choice of 175 or 180. All right, the 180s, because at 178 they're going to be out of the money slightly. They're going to be a little cheaper. But if I buy 175s, then I'm already $3 in the money. All right, now chances are I'd rather pay a little less, and the stock is a pretty volatile stock, so I'd probably do the 180s, and then I'd click OK. Okay, and then again, it's going to give me bid and ask here, but what I'll do is I'll bring it into my level 2, and just bear with me while we do this. So again, bring it up here, and there's the contract. So these are trading. I mean, look at that. So basically, if I want to buy the May 180 calls, which means the stock on May 15th must be above 180 to be in the money, I'm going to be paying, right as of now anyways, 1685 by 1715. Now you might say that's a big spread, but considering it's that price, that high of a price, that's not that huge of a spread. I mean, it's about a 30-cent spread. If you map that to a $2 option, it's probably about a 3-cent spread or a 5-cent spread. All right, so then number one, I'm starting to look here. Now I want to analyze. Okay, well, what's my premium? All right, well, right now, again, this is a little skewed because we're dealing with a stock that's trading currently at 187. But let's just say these are the 180s. So right now, how much are these? Can anyone tell me how much these are in the money as of if I were to buy the 180s right now? So approximately, just give me an approximate number. So how much, if I were to buy these right now, let's just say, how much are these in the money, these options? Yep, 772, right? So if you take 180, which is the strike, okay? So 180 right here, and then the stock is trading at 187.72. So it's in the money by $7.72. Okay, so now I know that I'm already in the money by 772, so that means that I have 772 of equity essentially in this. So what you want to do to find out the true premium, take a subtraction here, subtract 772 from this option price. What does that take you to? It takes you to about $9, a little over $9. So now I can get a true read on the premium. So it's costing me $9. What type of percentage is that? Well, let's go find out. Okay, so $9 divided by 180, we'll call it 188, 4.79%. So I'm paying a 4.79% premium on this. Is that a big premium? It's actually not that big. I mean, if we had a better pattern, and again, I'm not recommending buying Tesla options, call options by any stretch, but if we did have a better pattern, you know, all I would need to do is get about a 4% move here or so, and that would be pretty solid there on the stock. I mean, we'd get a good money maker out of that. So these are the types of things you look at, Nick. I don't know if you have more to add there.
No, you said it perfectly.
So again, you know, these are the types of things, and then obviously as it goes up, I mean, again, we're just using this chart, but let's say Tesla goes up to the 20 moving average. If I'm in the money by 50%, I mean, and we're into the 20 MA, I might consider taking it off the table, you know, depending on what the resistance is. Maybe I leave it and it pops to the 50. Now you have a little pivot resistance right up here, plus the 50 MA right there. So then again, you kind of start looking at that chart to get yourself a good exit, okay?
And again, just to go back, it's all about the methodology. I mean, it's knowing where your major resistance levels are, knowing where your major support levels are, and that's, you know, you could see just really using methodology what we've been able to do this year, trading options. I mean, it's been pretty remarkable.
Absolutely, so true, so true. And again, not to say we're not going to have some losers along the way, but it's all about at the end of the year, at the end of the whatever, you want to see that P&L, you want to see yourself just growing. You know, if you have 8 winners and then 1 loser, that's fantastic. But again, you are going to have losers, which is why we recommend such a small amount of your account in each trade. Okay? Karthik saying, I have heard some people recommending to buy calls or put options that are 12 to 18 months away. Do these things work? I don't personally do that because, you know, I can't tell you where the stock market's going to be in 12 to 18 months. I don't know. I don't know if Nick can either, at least not with such accuracy that options are required. So I really like to stay in a time frame where I feel okay with predicting the market or a stock. And I don't know, Nick, how you feel about that.
Well, sometimes, like, just say, for instance, if you look at the dollar, I mean, I'm very bullish the dollar, maybe not in the short term, but when it hits my level, I'm ultimately expecting the dollar to rise throughout 2015. So there would be a time where I wouldn't have a problem with somebody going out with an option for a longer period of time. I mean, I might buy a UUP LEAP option. LEAP option stands for long-term equity anticipation securities, generally 9 months or longer. And that would be a time where I would consider doing something like that. But all in all, it really depends on what the chart is telling you, and you know that's really the meat and potatoes of everything.
Yeah, and just keep in mind, I mean, the further out you go, 12, 18 months, you're going to be paying quite a bit of premium for that. But again, you are getting, you know, to hold it for a long period of time where you're giving that stock or that commodity or that ETF a long period to actually make its move. So again, you know, there's different pros and cons to it, and like Nick said, in the right situation, if you have a great monthly chart, for instance, it's going to take 12 months to play out, that might be a great way to handle it. Okay? All right, let's see what else we have here. Andrew saying, due to the added X factor of expiration, what's a safe number of calls puts to manage at a time? Also, Garreth is, hey, folks, recorded. The fresh greeting every day. That's awesome. It's always on point. Thanks for all you guys do. You're welcome, Andrew. We appreciate the kind words. So I mean, again, I think Nick would agree here, is that it's going to be different for each individual investor. For instance, I'm okay owning 100 calls, 100 puts, maybe even more sometimes. But that's because I have a huge swing trading account. I have other investments. If you have a $10,000 account, you know, you're obviously going to be a lot smaller. So it's really each individual, and we all have to look within ourselves. And I always say this in the chat room too, and even in the research center. You know, we each have tolerance levels for risk that are different. You know, someone that's retired is in a big different position than myself. You know, and so I would just recommend going with it that you feel proper, but again, 1 to 3%. Even if you have a $10,000 account, don't worry that that's not a lot of money in each play, because when you make 100% on it, it doesn't really matter, frankly.
That account will build up quickly, and something that traders got to realize is you always want to start small. You will grow, and it's just like when you plant something in your backyard, you plant a little tree. It starts out small. Next thing you know, that tree becomes big, and that's how you want to take the approach. You want to nurture yourself, learn, and then let your account grow, and you'll be surprised how quickly it can get there where you want it to be.
Absolutely. Rhonda's saying, do you use TradeStation intraday options analysis window? I actually don't, Rhonda. I don't know if Nick does, but you're saying it has a lot more information. Do we need to pay attention to things like Vega, Theta, Gamma, Delta shown on this screen? To be honest, I don't. Now, I think mentally I kind of analyze it accordingly based on looking at what type of premium I'm paying, and I think, hopefully I kind of helped you guys understand how to do that for yourself, and I think that's kind of what you're doing when you're looking at some of those indicators. But Nick, do you use any of that stuff?
I don't, but the reason why people do use that is because they're putting on different types of strategies. They're using straddles, they're doing put spreads, call spreads, they're doing other types of strategies, and they're trying to figure out, what the movement is going to do in order for them to come out. We're not looking to really hedge ourselves, and those are all hedging strategies. We're looking to really make a grand slam home run, and I'm going to put it out there just like that. I mean, if you go ahead and look at the track record of the options, you're going to see 50%, you're going to see 100%, you're going to see 140%. Those are the kind of gains that we're looking to get. If you're looking at, the gamma and the theta and all of that, I mean, we're speaking Greek here, but you're not looking to make a grand slam hit. You're really just looking to work a strategy out there, and when expiration comes around, you've made a profit. Now, if you're an institution and you have thousands and thousands of contracts, that stuff can work. But predominantly, the clientele that we have, we're a bunch of traders that are looking to make a good living and looking to really capitalize on these options. So really, all of that stuff, we could just toss it in the trash. If you want to study it, that's fine. I know TradeStation has a very good program for it, looking at all of that different Greek information. But the reality of it is that that's nothing that the strategies that they're implied for are not what we're going to do.
Excellent, excellent. Yeah, it's so true. And again, just keep in mind, guys, a lot of those institutions, they're using millions of dollars in a single options play potentially, so they don't need to make 100% to really have success, because they're doing it with volume instead, with a lot of contracts. So some of those strategies are great, but I'm playing options to make money, ultimately, and a lot on not as much risk or not as much money that I'm using. Brell saying, if a stock is moving big during the day, do you enter an options trade then, or is that chasing? Yeah, I mean, you really don't want to. It's the same principle as with a stock. It would be considered chasing, because the same thing could happen. I mean, if we chase a stock and it then reverses on us, well, we lose money on the stock when it goes against us. With an option, it's even worse, because you can literally take 10, 20, 30, 40% loss because that option is going to move so violently on a move. So again, definitely same thing. Never chase. I always look for options of stocks that haven't made a move yet. I'm anticipating, based on the PPT, again, it all goes back to that PPT, of that next move. So like a bull flag with a time count. All right, well, it hasn't rallied and hasn't shot higher yet, but that's what I want to see, so I can pick up some options on it, or I can do the stock on it. Okay. What's your rule on leap options? Do you have a rule on that, Nick?
Yeah, it was basically what I talked about before. So like I said, I have no problem getting in leap options. We're not going to do a lot of them, Gary. I don't think you and I will. But like I may buy a leap on like the UUP or something where I have such a big target, and I think that could play out throughout the course of the year. So I'm not opposed to leap options. I think there are a purpose. Leap options, for those of you that don't know, are long-term equity anticipation securities, hence the acronym LEAPS. They're generally 9 months or longer, an option that's 9 months or longer. Typically, they'll go out maybe a year, even 2 years out. But generally, we're not going to do a lot of that. I don't feel we will. I may do a leap option, though, with something like the UUP, which I believe the U.S. dollar index is going to go up into 2016 once it pulls back, once it completes its pullback. So, there's nothing wrong. As long as you have like that big time frame horizon, that big monthly chart pattern that's telling you this is where price is going, a leap option could be a way to trade it.
Excellent, excellent. Mark saying, I just wanted to say that I've had great success with options on liquid or high volume stocks using the PPT. I've traded options for years, but once I found your site and learned the PPT and used it, that the method to pick the stocks and then look near term for the money 2 to 3 months out, I've had great success. Thanks for everything you taught me. Well, thank you, Mark. Thank you very much. And just great to have you as a member. Great to have each and every one of you here tonight, guys. It has been a pleasure, and I hope you guys are learning some stuff about options and kind of more confident in picking up the plays. And again, Nick and I are still around for emails post this if you guys do have any questions, okay? Don saying, how are options profits taxed like equities themselves? Nick, you might be able to speak on this a little bit more. I think it's pretty much just capital gains. I mean,
yeah, it's P&L for us because we're professional day traders, but all in all, make sure you have a good accountant, please. I ran into an incident, many, many years ago with the IRS that, I was writing covered calls and they thought that I was, making these $1 million profits, and I was like, I'm only making thousands, people. So please have yourself, make sure you have a good tax guy, a good tax person, a good accountant. That's going to be worth its weight in gold regardless. But as long as you're a professional day trader, I believe it's just P&L.
Yeah. David saying, if you still believe in the stock using PPT, why not roll it over into the next month? Well, to be honest, if the play, let's say we buy 6 weeks out, right, which gives you a little over a month. If we're in an options contract and it's down 90% on us, and I've had that happen to me before, right, and it's coming towards expiration, it's obviously not working out, right? I mean, there must have been something wrong. I obviously expected the underlying stock to move before. So I wouldn't necessarily roll it into another month. Now, again, with the USO, that example I used earlier, I think, which was a great example. In that situation, I got most of my money back, and then I waited patiently for the pattern to form again, for PPT to set up again, and then I went into it. So I think you can do that. But again, generally, I would think Nick would agree with me, is if we end up taking a loss on an option, it obviously didn't work out, right? I mean, the stock didn't do what we thought it was going to do.
100%, Gareth. I mean, we're not when I see people do that, it's because they're angry at the stock. And one thing I always want to stress, and it has nothing really to do with options, is don't take stocks personal. We don't know Tim Cook and Apple. We don't know any of these CEOs. All we do, when I look at a stock, they are just an instrument for me to make money. I never want to take a stock on a personal level and try to fight it or get revenge on it. And that's what I find most people do when they start rolling things over. They're trying to get revenge on a losing position. Cut your loss, call it a day, and move on to the next trade. That's the best way to play it.
Absolutely. Yeah, that is so true, folks. It's almost better to stay away from it for a couple days and then kind of clear your head and let that kind of anger, sometimes people get very angry at a loss. Oh, I can't believe it didn't do that. Oh, I'm so mad, The worst thing you can do is just blindly go right back into it at that point. So I think that's a great point. Let's see here. I'm just looking for questions that aren't repeat that we haven't covered already. Ren saying, as a member using PPT, I bought GDX calls with Garreth at 65 cents, sold half at 121, then rebought them back at 65 cents using PPT on the pullback, and now they're already up to 95 cents. Thank you, Nick and Garreth. The play paid for my new year-long option subscription. Thank you, man. That's awesome to hear. Thank you. And again, guys, that's what we like to hear. I mean, that's what we're here for, to make you guys money and then, just have you guys as long-time members. We just love it. Love it. Jerome saying, great job, guys. Keep up the great work, everyone.